Everyone wants to say they're a value investor. I hear it from Kathy Wood when her stocks are down a ton. I hear it from Bill Miller, who everybody calls a value investor. Spoiler alert, he is not. So what makes a value investor? Mo and I consider ourselves value investors. So I think everybody has a different definition of what value investing is. Mo, what's yours?
Very, very surface level,
Yeah.
Especially when it comes to stocks. I want to find companies that have good financials that I can buy cheaper than I perceive the value to be.
Right. One of the criticisms that value investors get is they don't understand growth. And I always say, no, we understand growth. We just don't.
We don't want to overpay for ridiculous.
We don't want to overpay for any growth. I don't care if it's ridiculous or not.
I don't care if it's 1%.
Yeah. You have to view buying a stock as buying a piece of a business. And that's so overused, but it's 100% true. I think to myself all the times that people tell me, buy Tesla because it's going up, blah, blah, blah. I'm like, okay, well, first off, do you believe you're buying a piece of a business? And everybody's going to say yes. Why? Because Warren Buffett and Charlie Munger say yes, right? But if you think that way, so one of the biggest Tesla bulls I know is a guy who owns a house in Mexico right between mine. But he doesn't think Tesla's ever going to go down, even though it's down over 50%. He thinks it's the future. But yet, when it comes to houses in Mexico, he's like, well, I want to see the pro forma. I'm like, well, wait a second. You're just following the ticker of the stock, but yet you all of a sudden want to evaluate the business. Why? Because people think when they're buying a small piece of a company, they're just buying a ticker symbol. And as long as the company keeps going up, great.
Just because a company's public doesn't mean you shouldn't look at the valuation.
Absolutely.
Or the numbers. Perfect example is Twitter. So right now, what we're saying with Twitter is you should just go and not look at the financials, not worry about anything.
Well, by the way, Twitter's private anyhow now.
That's what I'm saying now.
Yeah.
It's private.
Oh,
So
yes.
you shouldn't go and look now.
So, value works. Value works very well. If you look at the best investors in history, it's not a coincidence that they've all basically followed some sort of value direction as determined by Ben Graham in Security Analysis and The Intelligent Investor. As Warren Buffett says, people say, well, it could be a fluke. Well, why is it a fluke that all these guys who come from the Ben Graham tree of investing all do very, very, very well? To me, value investing is about something very simple, even more surface than Mo said. How do I buy $1 for a lot less than $1?
Yeah.
And that lot less than $1 is margin of safety.
Right.
So if so far you've been watching this video and this makes a lot of sense to you, just stick along because this is what happened to me that made me go, oh, I get it now. That was my journey. I used to believe, well, if something's growing like crazy, then it's going to keep growing and I should want it no matter what. Well, we just did a video today on AMD. And the interesting part about AMD is the thing that people overlook is they've issued 70% more shares in the last 5 years than they had before. What that means is if the company's revenue and profit grew 70% from the last 5 years, you gained 0 as an investor because now you have 70% more partners than you did before. And that is something that people don't realize. And that's what overvalued companies do. They dilute their other shareholders.
Instead of taking on debt.
Right. So if you're buying so if you're buying a piece of a business, you're then being diluted, you have a smaller piece of that business. And it's also no coincidence that over long periods of time, the fundamentals of the business get better. So what 3 questions I always ask? Well, let's see if you can remember. What do I always ask when I'm looking at a company?
Oh boy. Is this company going to be around in 5 years?
10 years, I would say.
10 years.
Yes, that's the first question. If the answer is yes to that one,
if the answer is yes, is their revenue and profit going to be more in 10 years
than today?
And if the answer is yes, can I pay a reasonable price for the company at this moment?
Today, correct. That gives me an ample return based on my risk, et cetera.
Yep.
Now, that's very high level, but it's a good way of me screening. Exactly.
It is if you really look at anything, and we're going to get more into it, it's all surface level. You have to start at the surface before you start going into the
peel away the layers.
Exactly.
And if the layer you pulled away goes, go deeper, then you go deeper.
Yeah.
The second it says, like, for example, that's questions I asked.
That's a good one. Is this business going to be around in 10 years? I've looked at some businesses and I was like, I don't think they're going to be around in 10 years.
And I wouldn't be surprised if they're not around in 10 years.
Yeah, and I wouldn't be surprised. So it's like, okay, I'm not going to go any deeper here.
Like Peloton. I would not be shocked if Peloton was gone in 10 years.
Correct.
I have no idea how to value Peloton. It loses money hand over fist. It's losing people. I mean, all these things I'm looking going, what would be shocking? Now, Microsoft, Apple.
I would be shocked.
I'd be shocked. And the next question is for Microsoft and Apple. Do I think their profit will be higher or lower 10 years from now than today? I think it'll be higher. But the third question, can I pay a reasonable amount of money for the company today that factors in that growth potential? And I think the answer is no on Microsoft and Apple. And we'll get into that. We'll use Microsoft as an example using our stock analyzer tool. But first off, so how do you find these value plays? we talk all the time about all these great investors. And you can go see, the great thing about value investing is the fundamentals are the same, but the analysis is different. One value investor could say XYZ Corporation is a value play. Another person say, no, it's not a value play, right? There's all these big differences in terms of how they still take the best fundamentals and still make it better. Mo and I disagree all the time on different companies. Like PayPal, for example. I think PayPal has a much bigger moat than Mo believes. Mo's like, Paul, I don't think the moat's there. I'm like, okay. Do I throw things at him? No. Do I get mad at him? No. I just go, no, I do think there's a bigger moat than, but it doesn't mean, by the way, that when PayPal was at $100 a share, I was buying it because it has a big moat. Exactly. I was still sitting there saying, but it's still too overpriced for me. Right. I have a list on my phone of the 15 or 16 companies that I want to own forever. But guess what? I own one of those companies today. Yeah. That's it. That's it. One of those 15, 16 companies. Why? Because being a value investor is saying, I can like something, I can like a company, but I don't like the stock price. And that's where I'm at with them. I still want to wait for those stocks to fall.
Yep. And so that comes to the question number 3. Can I pay a reasonable price for it today?
Right. So here's how we find stocks. One of the ways we do it in our software is we go to our 8-pillar search. Now, the great thing is we can sit there and pick any one of our 8 pillars and screen that way. So let's say I'm okay looking for all the companies that have the attributes that make sense. High 5-year return on invested capital, revenue growth over 5 years, net income growth over 5 years, the same or decreasing shares outstanding, low debt compared to free cash flow and cash flow growth. Now, I won't necessarily care about the valuation of PE and price of free cash flow. Because my first goal is, let me find the companies that I like that fit these attributes. I hit go, and boom, all these companies pop up. So many options. By the way, one of them was Microsoft. Look right here, Microsoft. But if you click on Microsoft and go to their 8 pillars, it says that these are overvalued. Now, does this mean they're actually overvalued? Not necessarily, right? Because if Microsoft was going to grow 20% a year for the rest of the time, I would literally sell my soul to the devil. Give me a contract. I will write that check today for $1 billion to go buy Microsoft. That would be a screaming deal. But I don't think it's the case. That's the case. Even look at the analyst estimates in our software. They don't believe over the next 5 or 6 years, they're not even looking at 20% profit growth over the next 5 or 6 years. Revenue growth, not even close. Low double digits. Yeah. That's the start of the process. That's how you look at these things. Then how do you evaluate them? Same way here. You use the 8 pillars. You look at the 8 pillars as a way of answering your questions. So like Mo, I'm gonna put you on the spot here. Like, what questions do you have on Microsoft based on these 8 pillars? What questions, if anything? I know it's a hard question, but the whole point here is he's gonna have different questions than me.
Yeah. See, Microsoft's a hard one.
You're right.
I don't really have a lot of questions.
Microsoft is a hard one because yeah, he's right.
I get the business. I understand what they're trying to do. Those 2 parameters tell me it's overvalued based on the returns that I'm looking for in the future. I don't really have any questions for it. Like I'm looking at Google right now. I don't really have any questions. You know what I'm saying?
It's funny. We talk about this all the time. I consider myself a lazy investor. I'd rather wait for the right time to buy these great companies that I have a lot less questions on. A company that's becoming interesting to me is a company that's down 13% today, Palantir. I have a lot more questions about Palantir than I have about Microsoft because they've just recently in the last 2 years become cash flow positive. They're still showing a loss for the quarter. There's a lot more questions and uncertainty about the future. The smaller companies that are still establishing themselves, those are the harder questions to ask.
This is a good example of questions I have. Meta. This is all 8 pillars. This is even showing that it is in value territory for me. And I can tell you that it is because I own it. For me, I'm saying usership. Is users going to grow from here or are they going to get smaller? Ad revenue. What's going to happen with that? Privacy. What's going to happen with that? There's metaverse. What's going to happen with their spending in the metaverse?
Yeah, there's a lot of questions.
All of these questions that I can ask about this of saying, are my assumptions reasonable with all of these other questions that I have surrounding just the numbers?
Yeah. Now, the great news about value is, guys, guess what? Everything becomes a value at some point. Yeah. It's not possible to be overvalued forever. That's literally an impossibility. And I urge you to go back 20, 30, 40, 50 years and go find the most overvalued companies and see where they are today. They tend to be the most undervalued ones today. Why? Because they become boring. They don't have the growth story anymore. Because people, when you buy not based on growth only and not on value, the growth will eventually slow down. Think about it this way. A company with $1 billion in revenue, a company with $400 billion in revenue. Which one's more likely to double in the next year? It's very obvious.
Yep.
The $1 billion company. But eventually, if it doubles every year, it'll become the $400 billion company very quickly. and then the growth slows down and stops. And eventually it becomes boring. And you have to find a way to buy them based on share buybacks, dividends, and other cash flow that pays down debt, et cetera. You have to get your return in a different way. The good news is that when they slow down, the same people who said buy because of growth want to sell because there's no growth anymore.
And that puts a price, it puts it right into your price target in many cases.
Correct. And the great news about companies like Microsoft and Apple and things like that, the likelihood of them falling 80, 90% are a lot lower. Okay. Now, does that mean it won't happen? Look at Meta. Now, we thought Meta was overpriced well over 250, and we started buying at 250, and we dollar cost average down. So we're down a lot. But I look at it going, I feel like this is a mispricing of the future. People think Meta is going to be nothing because they're not getting the 5, 10, 20% growth rate in their users that they used to. And Apple has the restrictions on advertising. I get that. I do get that. That's affecting everybody. But I believe that with their cash flow and their balance sheet, they will figure out a way.
I think you said an important thing. You said it's affecting everybody.
Yeah.
So it's not just Facebook specific.
Correct.
Or Meta specific.
Right. So these are the things we look at. Now, when we do find these companies, let's put it in the stock analyzer tool to understand where we stand on a company like Microsoft. So Microsoft's currently at 225. All right. So Mo, I'm going to pick a 10-year analysis on Microsoft.
Okay.
I can do 1 to 20 in our software. I always pick 10. Okay. So give me your assumptions for revenue growth over the next on a low, middle, and high. Because remember, we want to be low. Like, okay, let's say things aren't as rosy in the next 10 years as they were in the last 10 years. But in terms of high, let's say things go pretty well. So what would you tell me for low, middle, and high?
5, 7, and 9.
5, 7, 9. Now, me personally, this is an example. I would have done 4, 7, 10.
Okay.
Yeah, because to me, I can see a world in which Microsoft does double their revenue in the next 10 years. Okay. Because cloud computing, a lot of other
subscription services,
all the subscription services, all these things that are happening. I'm like, the world's becoming more and more technologically advanced. More and more people around the world will start using Microsoft Office products, etc. So, do you mind if I change to 4, 7, 10?
Go for it. And
by the way, the reason I'm okay with 4 is, let's say the world goes through a lull for 10 years. Yeah. I still think they're going to grow 4% a year. That's like, to me, a no-brainer. All right, profit margin. As you can tell here, their profit margins actually increase as time goes on. Last 10 years, they've averaged 28.5, 31.8, and 34.4. So, Mo, hit me straight.
29, 31, 33.
I like it. Free cash flow margin.
Same
thing. Now, remember, the reason we pick that is over long periods of time, companies should have very similar earnings, profit margin, and free cash flow margin. They should be very similar. Now, PE and price of free cash flow. Guys, this is all part of the process. It's 24 and 26. You should pay a high PE for a really good moat and or really good growth levels. As Microsoft becomes bigger, it's going to be harder. And this is what's the PE going to be in 10 years, not today, in 10 years at the end of our analysis. Because we're trying to come up with an end value for the company in the software behind us.
About 14, 15, and 16.
Yeah, I see. No, you know what? I think that's so tight, but I like it.
It is tight. Usually I stretch it out by 2.
Yeah.
But I thought that 14 would be maybe too low, 18 would be too high, so I kind of put 14, 15.
13, 15, 17, 14, 15, 16, whatever. Now, our final one is desired annual return. Guys, you can get 9 or 10% with a long-term ETF. Our goal here is to have margin of safety, like we talked about earlier. And how do you get margin of safety? With a higher return, because the higher your return, the less you pay, right? The more you pay for a company, the lower the return. So if you're watching this video and you're like, this is intimidating, I don't know if I can come up with these assumptions, don't worry. 1, practice. 2, I'm gonna explain to you how you can use this community right here to understand and get better at making these assumptions. It's just about practice. When I first created my first model, I was like, what am I doing here? Like, how do I do that? I remember first being told by Gary, make a model. I was like, what? How?
Yeah.
I didn't even know how to make a model. And I just went out there and did it. And now you can watch from our 1,800 plus videos that I do this very easily. Okay. But that's the whole point of this community, which I'll get to in just a minute. So our desired annual return, Mo.
Man, I could 12, 14, 16. I even think 16 is a little too high.
So let's do 12, 13 and a half, 15.
Okay.
So as our assumptions are getting higher and higher and higher and better, bigger and bigger and bigger, we want more return because they're less likely to occur. But I don't think you should go much lower than 12% in the deal.
Correct. It's not worth it. Invest in an ETF.
Now, we have users in our chat who've said, but if you're already making really, really low assumptions here, why shouldn't I have 10% here? Valid point.
Yeah, it's very
I will
valid.
not argue that. If your assumptions are super low here, I do think 4% is really low. I wouldn't blame you if you did 10, 13, 16, or 10, 12, 14. I don't blame you. But that's what I mean when I say every value investor believes the same high-level things, but their implementation is different. Mo and I will look at Microsoft, I bet you, and if I just said to him, you do it and I do it, we probably would end up with pretty similar numbers on the end result, but we'd have differed all along the way. We would have differed along the way. There's a reason why with our 6,000 community members, this is the most used tool. It's literally like, Paul, I ran it through Stock Analyzer tool. What do you think? And they send me screenshots of their selections. And I'd be like, oh, I think you were fair there. I actually think you're too low here. I think you're too high here. There's all these different assumptions you have to make. So we hit the Analyze button. We come up with numbers, 6 numbers. Low, middle, and high on a multiple of earnings, and a low, middle, and high on a multiple of free cash flow. Okay, they're all in red. The low side is 106, the high side is 160, middle is 130. All right, so what does that mean? Based on these assumptions above, you can make a 15% return if everything comes out if you pay 160. Now, just to show you how much this can change, let's change this to 12, 13, and 14. So instead of 131 and 162, it becomes 136 and 175. Hell, if you only want 12% all the way across the board, it's pretty close to the number. We're at 150 and 200. The point I'm trying to make here, guys, is the numbers are what they are. It's all a matter of just putting the numbers in and saying, what return do I want? Heck, look at this. Ready? Let's do 6% across the board. If you want to own Microsoft and make 6%, you're buying it all day. All day long here. Even on the low side, you might want to wait a little bit. The point is, you've got to remember that the company will probably end up doing in stock price what it does fundamentally. It's as if richer, wiser, happier. One of the guys says it very simply. I just look at it saying, okay, if revenue and profit go up 10 times over the next period of time and the stock is reasonable, the stock will probably go up 10 times along the way. But if you look at companies like Intel and Cisco, which have much higher revenue and much higher profit than 20 years ago, but their stocks are still selling for lower than they were 20 years ago.
Exactly.
That's the difference, right, Mo? And that was a big revelation for us.
Yeah, it was. It was incredible.
So then, guys, what I do is I add it to my watch list. And I currently have the stock at 170. Now, the stock is currently at 170 on my watch list. It doesn't mean I'm buying it at 170. It means I'm doing more research. But my watch list has currently 98 stocks on them. And I went through the stocks, put them in my Stock Analyzer tool, add them to my watch list at certain prices. And I get an email and text, message on my software, and a message on my mobile app when it hits that.
Yep, I have Microsoft right here for $200. Not meaning I want to buy it at 200, but I'm interested in going and looking at selling some options on it at 200.
Sell some puts on it. And if you don't understand that, another reason to join the community, because it's a way that people have made. People here are paying $1 a day to join the community, and they're making thousands of dollars a month just selling options on stocks they want to buy. In some cases, the point is there's so many ways to make money in the world of investing. And you can pay yourself for waiting. That's what we're doing when we're waiting for Microsoft. At 200, and by the way, I'll probably do it at 200 too, where I'll start selling puts at 150 and below on Microsoft. Get some income. If it hits, I own Microsoft. If it doesn't hit, I keep the income. And when you're doing the Stock Analyzer tool, that's why the community is so important. Go in the community. You can search exactly for Microsoft. So I go in the community chat, and I might type in MSFT, search messages, and look, it has all the locations where MSFT is mentioned. All these locations where it's all mentioned. You can jump to the community. You can jump to that chat and say, guys, I'm talking about Microsoft, or just start a new one in the general chat or the stock chat. Guys, I'm looking at Microsoft. What do you guys think of my assumptions? Take screenshots, and people are really engaged. Thousands and thousands and thousands of messages are displayed every single day in multiple chats to keep it organized. Mo and I are in there every single day talking.
Yeah, here's another right here, the tech sector. You can come in here and talk about specific stocks if you want to, right in that sector. I mean, look how many. Let me erase this. Look how many chats there are that we have going on in here. We have so much going on here, and exclusive videos, a few good minutes. These are videos that you guys choose. You guys say to us, hey, we want to look at a different company, a smaller company, Marine Max. It's a small boating company. You could say, hey, this fell into my 8 pillars. Can you guys do a video on this? We will do it for you. You get it if you're in the community.
So that's the software. It gives you everything you saw, plus so much more, 8-pillar portfolio. But here are all the things. Mobile app, 8 pillars, 30 years of financial data, stack analyzer tool, exclusive daily content that Mo was just talking about, access to Mo and I, real estate calculator, which is being developed soon, which is the real estate calculator version of stock analyzer tool, stock screeners, retirement calculator, our EM community, and you can cancel at any time. Guys, this is $1 a day. I don't even want to get into what you waste $10 a day on. And this could literally secure your financial future and make you a ton of money in the long run if you use it properly. Worst case, it's giving you peace of mind. And one thing that's very new that we're just launching right now, we're just finishing up, is our 8-pillar screener. This allows you to take all of these metrics that you love and put in exactly what you want to do. Greater than, equal to, less than, etc. The EM pillars, the income statement, cash flow statement. Show me the companies that fit these metrics. And guys, when I tell you that we're just scratching the surface on our software, I'm absolutely 100% true on this one, because Mo and I were creating the software for ourselves. And this is the software that I and Mo personally use to analyze our companies on a daily basis. I don't use anything else for analysis. Why are you laughing?
Because we have friends that message us in group chats and say, hey, can you run this through stock analyzer tool?
Yeah.
Or see what the 8 pillars are on this.
We always get that, and I just tell them pay for the software. And they do.
They do.
So, but the point is, they want to be lazy and sit there and say, hey, well, you're already up for it. One of my friends, he always says, Paul, can you use it? I'm like, yeah, I'll get right to it. I'm doing it right now. Hang on a second. And I just never do it for him because he has the software, and I just sit there and laugh about that. But anyways, but he's also lazy. This tool is going to be so beneficial for you to be able to screen these value plays. You can sit there and look at all the metrics, and it's only going to get more detailed. This software is the start for us because we will be doing this for the I'm 41, Mo is 33. I plan on investing in stocks for the next 60 years, assuming I make it to 100 or further. As long as I'm alive, I'm going to invest in stocks, and this is going to be my tool for it. So this is all available for less than $1 a day. And when I tell you to sign up now, it's so easy. Everythingmoney.com. Go there, sign up. It's so easy to do. You'll have access immediately through your app, through the desktop, all the stuff. Go there right now. It's a no-brainer. I appreciate everything, and go make the best financial decision you're going to make today. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?